So today we're solving the COMM 217 Fall 2011 question 2. We start by reading the requirements. So they asked for us to prepare the journal entries for the transactions that occurred in January 2011 and the adjustments. When we they asked us to label our adjustments starting with the letter F. We should just make sure to properly label everything as we're solving. And then after that, they'd like us to list out our transactions, the effect, and on the profit and on the total assets. So the journal entries, the adjustments, the profit, and the total assets. Now we can read the question and we can begin. So as we see, we have for part number A, they purchased a computer with a total of $8,400 and they paid $2,000 cash. The rest was on a 1-year note payable. The interest is $600 and the equipment depreciation is $350 per month. So whenever we're starting this problem, we should start, the best thing to do is to first label it A, and then we can start by saying we're going to for sure be debiting and crediting accounts. So we know that we have just purchased computer equipment. With a value of $8,400. Now, we know already that we used cash to buy, but only for $2,000. And we know we have a note payable of the difference. The difference would be the $8,400 minus the $2,000 we used in cash to give us $6,400 on note payables. Now, you have two options. You can move on to the next, or what I'm going to do is I'm going to start by giving you also the adjustments at the end of the month. As we see in this question, we are going from January 1st to January 31st. So as we are only dealing with 1 month of accruals. So in this question, we are going to start by labeling F for our first adjusting journal entry, which we know is done on January 31st. We write in the date. And now we can debit. We are going to start with, they mention our depreciation expense. And that we know was $350 for the month. And we can credit our accumulated depreciation for equipment of, again, $350. Now, we also know that at the end of the month, we've accrued interest on the note payable we took out January 1st. Therefore, we need to consider how much. So we have interest expense, and then we also need to have our interest that we need to pay back, so interest payables. Now, to figure out how much, they tell us that for the year on this note, on this 1-year note, there's $600. So we're dealing with $600 over 12 months, and we're only looking at it for 1 month. So we look at it over 1 month divided by 12. So we divide this by 12, multiply by the number of times we need it, number of months we're accruing, which is 1. That will give us $50, which is the amount of interest we now owe at the end of this month. That's for part A. Now, if we go back, let's look at part B. Part B mentions that we get a 1-year malpractice insurance, so insurance policy, for $12,000 cash. So we know that at the beginning of the month, we've just purchased it, so money has gone out, and now we can start by recording first our transaction. What did we do here? We prepaid insurance, and we used cash to do so. Now, again, I'm going to go straight into the adjustment so that you can see which one is associated with which. So for this one, at the end of the month, how would we adjust this? Now we've prepaid our insurance, but now we've used some of the insurance as of January 31st. We've used 1 month of this prepaid insurance. Therefore, we have an expense. We have an insurance expense, and we have to decrease the amount that we have in our prepaids, which is our assets associated to that prepayment. So now we need to figure out how much exactly we have used. So once again, we purchased it at $12,000. We're using it over 1 month, but this $12,000 is associated to a 12-month time period. Therefore, we multiply by 1 over 12, which gives us $1,000, which is the amount that we fill in to our journal entry. Now that we're done with requirement number B, let's go to requirement C. So requirement C looks at purchases that we've made for office supplies of $3,800 on credit. And they also tell us that at the end of the month, we have $500 left. So for this part of the question, we are looking at part C first. Let's just record our purchases of the office supplies. So we debit our office supplies, which are our assets that we've just purchased, on an account payable. This was for an amount of $3,800 and $3,800. However, they do tell us that we need to make an adjustment because we did not use everything. We used some, but not all. So now we need to record an expense as of January 31st. So we know we're going to have an office supplies expense, and we know we're going to have to decrease our office supplies because we use some of them. But how much? The best thing to do here is to make a T account. So we're going to write an office supplies, and let's just draw in a small T account right here. Now in this T account, we know we purchased at the beginning of the month $3,800. We don't know how much we used, which goes into here to decrease it. We do know that at the end of the month we end up with $500. If we look here, that means that we have to do $3,800 minus the amount that we used is going to give us $500. If we solve this, it gives us that the amount we used was $3,300. So we can just put in here $3,300 and $3,300. Now, for the next part, let's move on to part number D. So he's a member of a law society and he needs to pay an annual membership fee of $720. He received the invoice, but he's only going to pay it in February. So we know that we're not dealing with a cash basis accounting, we deal with accrual basis, so we need to just record whatever he's accrued, not what he's going to need to owe or what he's going to pay in the months to come. So they also tell us that the membership coincides with the calendar year. That means that by the end of the month, he's used 1 month of this membership. Therefore, we have an expense that we need to record. So for part D, we have to record a debit on the membership expense, and we need to record a credit on the accounts payable because he's going to owe them, but he's not going to pay them until February. How much does he need to record here? Well, we're looking at $720 for a 1-year period. He's used it for 1 month, so again, we're doing 1 over 12. And we get an amount of 60, which we can put into our journal entry. Now, our final journal entry is looking at performed services. So we know that the client performed services but was not paid yet for them. So at this point, we know he's earned $6,000, but he has not been paid for them. Therefore, we need to make an entry. So we need to look at a revenue that he's earned, and something that he's now owed. So if he hasn't been paid, we put it into either trade receivables, account receivables. Your teachers will let you know which one they prefer or if they accept both. And then we need to record a revenue. Revenues go up with a credit balance. Therefore, we write in service revenue. And they tell us that this amount was 6,000, so we just put it right into the journal entry. Now, that's requirement number 1. We've completed it as we were told to. And now for part number 2, they simply want us to look into each of these journal entries and explain how they affect our profit and our total assets. So we've prepared a chart here. It would be easy for you guys to do it on your exam. Simply listing out the transactions, the effect on the profit, and the effect on the total asset. Now I'm going to list out the transactions, but I'm going to list them out in the order we just made them, not in the alphabetical order, just so that you can see the ongoing effects of each question and how the adjustments affect also our profits and our assets. So I'm not going to flip back and forth again, but as you can see, for part number 1, we're looking at the computer equipment purchased. So we know for A, there was no effect on profit, for the simple reason that if we look, we here are dealing with the effect on here we have a computer equipment that was purchased, increasing our assets. We have cash here, which decreases our assets, and a note payable, which increases our liability. Once again, when we're looking at these, we need to make sure that each journal entry is balanced in the equation that we know is the major accounting equation. I'm going to write it out on the bottom. I have more space. Assets equals to liabilities plus shareholders' equity. If I were to test every single one of my journal entries, this equation would balance at the end of them. So once again, here for our depreciation expense, we are going to decrease our shareholders' equity, and we are increasing a contra asset account, therefore decreasing an asset account. Now, once again, let's finish part number A, interest expense. The interest expense we're dealing with will again decrease our shareholders' equity, and our payables increase our liability. Now, since we see in here that we have a balance, our effect on our profit here would be 0 because we're only dealing with assets and liabilities. However, we have an effect on total assets of 6,400. How did we get this? We said we had an increase of 8,400 and a decrease of 2,000. Now, for part F, we accrued our 1 month of depreciation. So we know that we have a decrease on our shareholders' equity through the expense, which is a decrease on profit of 350. How do we know this? Because our profit is equal to our revenues minus our expenses. And we know that our assets, as we wrote before, are equal to our liabilities plus our shareholders' equity. Our shareholders' equity will include our profit, our retained earnings. So our shareholders' equity includes our retained earnings and our shared capital. So our retained earnings, profit goes into there. So we also know that here we have an effect on profit, and we also have an effect on a contra asset account, therefore decreasing in assets. So we have a decrease again of 350. Now, for the interest that we've incurred on the note payable of $50, that decreases because we have $50 because we have an expense. However, we have no effect on our total assets. Now, for question number B, we can go back and do the same thing. A prepaid insurance increases an asset account, and cash decreases an asset account. And again, for our adjustment for this one, we have an insurance expense which decreases our shareholders' equity and decreases our assets. So if we go back in here and adjust it, we know that for B, we have no effect on profit because we're only dealing with the effect on our assets and our cash. And we're also not going to have an effect on total assets. Why is that? There is an effect, but the net is 0 because we had 1,200 that was increased in our assets. However, we also used our cash to decrease it, giving us a total of 0. And for the adjustment, we know, as we have seen here, that we accrued insurance expense of $1,000, therefore decreasing our profit by 1,000 and also decreasing the amount that we have prepaid, therefore an asset, by 1,000. For part C, we're looking at the office supplies that we purchased, so we increase our assets and we increase our liabilities. Now, for our adjustment to this one, we know that we have an insurance expense decreasing our shareholders' equity, and we have a decrease in our assets. Now, when we put this in, we see that for C, we have 0 effect on our profits, since for part C, there are no expenses or revenues. However, we do have an increase in our assets that we have purchased supplies, 3,800. And then for I, we have a decrease, since we have an expense that was accrued of 3,300, and we have a decrease in our assets since we use the supplies that we purchased. And for D, we are looking at the membership expense that we have used during the first month, and a liability because we need to pay it. So we know that here we have an expense decreasing our profits by 60, and we have no effect on our total assets. And then the final one, E, is our total. We have the services revenues. We have here an asset account that has increased, and we have increased our shareholders' equity through revenues. Therefore, we can go into here and say that we have to increase our profit this time by 6,000, and we have to increase our assets also by 6,000. And that's it. We have filled out the full question. So if we double check, we went through all the transactions that have occurred. We prepared the journal entries, the adjustments, the effect on profit, and total assets. If you have any more questions, go to your respective teaching assistants or your teacher, and they can give you more clarification.